Hello everyone and welcome to the special Halloween edition of the videos on my channel. Today we will discuss about the current situation of US and the potential of recession. You will let me know what you think in the comments below. So we'll start our conversation with the coincident the leading indicator for the US market that a little bit anticipate or track the performance of the American economy on a constant basis. So let's see a little bit. One of the important ones that I really like to see, it's this one, figure number 5. You can see that the index of leading and coincident economic indicators. We can see that the leading indicators, so those indicators that tend to anticipate the performance of an economy, are in red, and the coincident indicator, which are in blue, they tend to track the economy as it's evolving. We can really see that the leading indicator is up when also the coincident after follows. We can see the leading indicators have wider variation than the coincident indicator, but we can see that every time we have a big drop, it has been transformed in actual recession. Okay, so we can see here that even two recession, you come down, recession, recession, again here down, recession, recession, recession of 2000. So this is the 2000 bubble. This is the 2009. This is COVID. And this is the Halloween special because we can really see a leading indicator that is frankly scaring when compared to the coincident indicator going in this direction. So if you really see like this a divergence of this magnitude has always been seen in 2009. Before, really, there was never this kind of incredible divergence between the two. So this is a first item. Another one is this picture here, which is the ratio between the leading and the coincident economical indicator, which basically tells you if it is below 1, that the leading indicator is negative, more than the positive coincident indicator, which means that once go below 1, that announce a recession. You can see that not always is necessary that it goes below 1. Even a down movement, consistent down movement can be the predictor of a recession. You can really see that is a recurring pattern. And here, guys, this is really scary. It's really scary. It seems we arrive at the level of 2009. I don't know why nobody's talking about it, but I think it's the best to bring it up during the Halloween special. So that's just something to consider. The fact that also Warren Buffett recently sold most of his shares in Apple and Bank of America in order to raise cash at around 25% level really makes me consider that it might be a good idea to do the same. So I put it out there, guys. You have been warned. Halloween and the Days of the Dead is coming, so prepare yourself. Then we have what else that I want to show you. By the way, this is all thanks to the Yardeni.com charts, incredible resource that is free for all. So if you want to play with this chart, you can connect directly to their platform, the Yardeni research, to their website, and it's a fantastic resource. So here, another point is the discrepancy between value and growth. It's really crazy after 2009 how the two really diverge. I'm not sure if we will ever see a track back because in 2000 it was like this difference already, and then was tracked back very, very quickly to see, guys, to see, because if there is a big recession, might be the values re-entering in line with the growth, but we cannot be sure about it. Another point that I wanted to show you is this Magnificent Seven versus the S&P X, the Magnificent Seven. Is really, look at the graph. You can really see that the biggest 5 stocks include the Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla are really pushing up with a PS, so price over sales ratio of 7.35, while all the rest of the market is around 2.91, 2.3. It's really like incredible the difference between the two universes. So if you invest in the S&P 500, be aware that the majority of your investment is towards these companies that are quite expensive, are also among the best in the world, but quite expensive. So if you have all your money in Tesla, it's a risky business. Same if you have it in Nvidia, you great performance, it's a risky business. So take your precautions. Of course, all of what I'm saying is just a opinion, is not an investment advice. Do your research before taking any decision. Consult a professional. Okay. Here we have the same graph, but for PE ratio. We can see that PE ratio to Magnificent 7 and PE ratio X Magnificent 7, it's really two different worlds. It's really, we're talking about 19.2 for X Magnificent 7 and 29.7. So a P that is significantly higher for the Magnificent 7, which reduces a lot the return. So we're saying that, for example, the implied return, earnings yield on the PE of 30, it's 3%. And if we see the implied return on a PE of 19 is roughly 5%. So there is a little bit of a difference. Both are roughly not compensating enough for the risk taken when we compare it with the current available returns. But just, for you to know, it's very scary business. It's a very scary business because decline in market multiple can really destroy the wealth that you put inside the company. So the growth trap, it's very, very bad, very quick to hit, which is when the multiples are slashed together with the revenues. So if take your precautions. Okay. What else I want to show you here? We have the performance over time as well. Forward P ratio, mega cap, large cap, small cap. We can see the small caps now are still quite cheap, when compared to the past, even. But the mega cap, we just saw super expensive together with the large cap forward P. So potentially interesting play for value, it's in the small caps. Let's continue with the bad news by checking also the favorite Buffett indicator, which is the Wilshire to GDP ratio, which is basically the total value of publicly traded shares divided by the GDP. We can see that over the last, so forever, okay, we see that the first numbers in the 1970, an increase here. We see next 30 years. So we have the peak at the dot-com bubble, and then it declined. The second increase here was in the housing bubble in 2007, the 2009, the bottom. And then we see a continuous increase here with a peak in COVID, boom, up to December 21, then inflation, tightening of the cycle, etc., down, and now we are again up among the highest ever. So a 197.75%. The mean, it's here at 75. Roughly even at 100 would be around kind of fine. We're talking about 100% of the cap is GDP. Okay. But when we are talking about 200, it's way, way above what has always been considered reasonable. We can see also other numbers. This one is very interesting. Value of public and private equity to GDP ratio. It's the same story. We have the dot-com bubble here at 200%. We have the housing bubble here at 188%. And then here we have 300% in July and December 2021, down, and then now we are shooting up. But here the value of private equity probably is lower than we would used to. So that it's also a lagging indicator a little bit more because the valuation of private equity tend to change less and tend to lag the actual change in valuation. So that might be also the reason why there is a difference between this number and this number. And to conclude with the little cherry on the cake, we can see how the federal government is spending the money. We can see that the net interest paid has been skyrocketing this very couple of years, arriving to how much even the country is spending on defense. So the country is spending as much in paying the interest and in defense every year. So I want to conclude this spooky episode just by wishing you all a happy Halloween. Don't be too much scared about the economy. Take your precautions, and we'll see you in the next video. Cheers.